Tonight's coverage focuses on significant price movement in the silver market, following a sharp decline during the latest trading session. Silver closed at $82.17 after experiencing notable downward pressure throughout the day. The move followed recent trading activity that had seen prices as high as $93.11 at the end of last week. The decline has drawn attention from market participants closely monitoring volatility and trading volume. The session was marked by a large red candlestick on the daily chart, reflecting sustained selling pressure into the close. However, beyond the price decline itself, the most striking feature of the day was the surge in trading volume recorded on March 3, 2026. Volume levels were reported to be approximately 2 to 3 times higher than those observed during the previous week. Analysts observing the session characterized the combination of heightened volatility and elevated volume as a potential selling climax, a technical term used to describe an intense wave of liquidation activity. According to the analysis presented, such events occur when a broad group of market participants simultaneously exit positions, often after rapid price declines. The result is a sharp increase in turnover as positions change hands. While some traders interpreted the drop as the beginning of a larger collapse, others described it as the possible exhaustion of selling pressure rather than the start of a prolonged downturn. A closer look at Tuesday's trading session reveals the mechanics behind the sharp decline. Silver opened the day at approximately $87 and briefly rose to $88 within the first hour of trading. However, that early strength did not hold. Selling pressure intensified as the session progressed, pushing prices steadily lower throughout the afternoon. By the closing bell, silver had fallen to $82, marking a $6 intraday range between the session high and low. The breadth of that price movement was accompanied by exceptionally strong trading volume. Market data shows that the volume recorded on March 3rd was significantly higher than the recent daily average, measuring roughly double or even triple the levels observed during the previous week. Such elevated turnover indicates that an unusually large number of contracts changed hands during the session. In technical terms, the session has been described as fitting the characteristics of what is known as a selling climax. This pattern typically involves 3 elements: unusually high volume, a wide trading range, and a close near the low of the day. Tuesday's session reflected all 3 conditions. The majority of the selling activity occurred between 11 a.m. and 2 p.m. Eastern Time. While prices continued to edge lower afterward, the volume per 5-minute interval began to decline into the final hour of trading. By 3:30 p.m., price movement had slowed considerably compared to earlier in the day. Observers note that this type of volume spike often reflects large-scale liquidation, with many participants exiting positions in a short period of time. The interpretation presented suggests that once such selling pressure has been absorbed, the supply of motivated sellers may diminish. Attention now shifts to how broader market participation may influence price action following this high-volume decline. With U.S. markets closed on the evening of March 3, 2026, focus turns to the upcoming Asian trading session. In approximately 6 hours, major financial centers including Tokyo, Hong Kong, and Shanghai are scheduled to open. These markets will respond to the same price chart and volume data that concluded the U.S. session. According to the analysis presented, international institutional participants may interpret the sharp decline and elevated volume differently than retail traders did during the New York session. The argument suggests that when a market experiences what is identified as a selling climax, the following trading day often presents a high-probability reversal setup. The reasoning given is that once selling pressure has been largely absorbed, fewer sellers remain active, potentially allowing buying interest to exert greater influence on price. The discussion also places Tuesday's activity within a broader historical context. Reference was made to October 15, 2025, when silver declined from $79 to $71 in a single session on substantial volume, following a rally from $68 earlier that month. The next trading day, the price reportedly opened higher, gained $4 by midday, and closed at $76. Within 3 sessions, silver was trading above $80. Another example cited was April 9, 2025. On that date, silver fell from $63 to $57 during a session marked by heavy volume after advancing from $52 over the prior 3 weeks. In the subsequent week, the price moved from $57 to $69 over 5 trading days. A third instance referenced September 22, 2024, when a large red candle on high volume preceded a rally that extended from $44 to $60 over the following 2 months. As this analysis concludes, attention turns to the broader perspective outlined in connection with Tuesday's market action. While the session's decline to $82.17 represented a notable short-term setback from last Friday's level of $93.11, The overall framework presented maintains that silver remains in a longer-term upward trend. The move from $22 in early 2024 to $82 currently was cited as evidence of a sustained bull market, reflecting a gain of approximately 370% over a period of just over 2 years. The commentary emphasized that, despite the sharp single-session drop, the underlying structural factors previously discussed remain unchanged. These include ongoing supply constraints, continued industrial demand linked to sectors such as solar panels and electric vehicles, and monetary demand associated with countries diversifying reserves. According to the argument presented, none of these broader conditions were altered by one day of elevated volatility. At the same time, the discussion acknowledged that no trading setup carries zero risk. Technical analysis was described as probability-based rather than certain. While historical examples suggest that selling climaxes have often been followed by rapid reversals within 1 to 3 sessions, it was stated clearly that exceptions can occur. Risk management strategies, including defined stop-loss levels for paper contracts or longer-term time horizons for physical holdings, were identified as essential components of disciplined participation. The key takeaway remains measured and factual. Silver closed at $82.17 on March 3, 2026, following a sharp decline on exceptionally high volume. Historical comparisons indicate that similar setups have previously led to strong reversals, though outcomes are never guaranteed. Market participants will be closely monitoring upcoming global trading sessions for further confirmation of the market's direction.